If you own a property in the UK, or you're planning on buying a property this year, something has just changed within the industry that could change your returns for the next decade. The 2025 budget is now out, and it is not a small upgrade. They've made some fairly large-scale changes. It's a structural shift in how the UK is going to be taxed, structured, and financed in the coming years for your investments. At RWinvest, we've been investing over the last 21 years, and we've seen a variety of market shifts, legislation changes, and things that you as an investor need to stay ahead of to make sure that you can maximize the profitability of the assets you're buying. This budget forces a rethink on some of the strategy you might be planning to use during the next property cycle. If you miss what's changed, you could end up with a strategy that leads to higher rates of taxes and less profitability on the investments that you own already, or any new investments that you're thinking of buying. You could end up holding the wrong type of asset or being stuck in a structure that no longer works for you. But if you understand and can get your head around what's actually happening early, it puts you in an extremely strong position to take advantages of those things before the wider market catches on. So in this video, I'm going to walk you through what the 2025 budget will mean for your investments, what it will mean for the UK property market as a whole, and the best way to protect your position moving forward. Most investors think changes in capital gains tax just mean paying a little bit more when it comes time to sell the asset. They assume it's the same across the board and that there's nothing that they can do about it. The budget 2025 has introduced new adjusted thresholds and new relief structures that have been specifically designed to reward long-term investors. This isn't just about how much tax you pay. It's about when you pay it and what strategy you're using to get the most out of your investment. If you've been flipping properties for quick profits, the new capital gains tax structure is going to hit you much harder than before. The government is actively discouraging short-term speculation by increasing duties on assets being held for shorter time frames. But if you're a long-term asset holder that's trying to build a portfolio for sustained income and long-term growth, you could actually benefit from this new structure and reduce some of that pesky tax burden. The key difference is how long you actually hold on to that asset for and what the intent of your investments look like on paper. The advice that I would give to any investor that's currently holding assets and wants to properly understand what the effects of this new budget will be on their current holdings would be to speak to a tax advisor before the end of the year. Maybe you have one already, in which case just ask them what the implications will be on the properties they're already working with you on. Or maybe it's not something you have currently, in which case find yourself one, explain to them the details of what you're holding, and ask them just to give a full audit on what the changes will do for those particular properties. If you're flipping, run the numbers and crunch as to whether it still makes sense to be holding those assets on a short-term basis where you will see the higher end of those taxations. And if you're holding assets for the long term, just make sure that you've structured them in the right way to get the greatest advantage from any tax breaks and tax relief that you're able to use. If you want to see how the new tax changes are going to affect the returns from your rental properties, we've built a free calculator that will do the maths for you. Just plug in your numbers and see what exactly you'll actually take home after the 2025 tax budget changes. Grab the link in the description. Speaking on taxes eating into your returns, there's another change that's going to affect your rental income directly. The budget 2025 has announced a 2% increase on income tax, specifically for dividends, returns from investment property, and savings income. This isn't about your salary. This is targeted directly at passive income streams. If your properties are generating £50,000 per year return, that becomes an extra £1,000 going to HMRC every single year. And if you scale that across a portfolio that's doing £200,000 a year, that then becomes an extra £4,000 a year going directly over to the taxes on your assets, which is something your pockets could really feel. The advice that I'd give to any of my investors that are looking at a lot of this stuff currently and planning their next move is just to stress test your portfolio's cash flow right now. Look at whether you need to target higher yielding properties maybe to offset some of that tax hit, or maybe you need to restructure the way your holdings are kept to maximize the allowances that you'll have available and increase your tax efficiency. While most portfolios will feel some of that 2% pinch, there is another tax that is only affecting a very specific bracket of properties. But if that specific threshold of property does apply to you, this is something you really should take note of. Most investors would assume that the government's new mansion tax on properties over £2 million is only really going to affect the elites or the mega wealthy, the types of individuals that would have sprawling estates in Kensington. They might think, well, I'm not buying a £5 million penthouse on Mayfair, so this maybe won't apply to me. But that's not actually how it will play out in practice. The new mansion tax will apply to any property in the UK that has a recognised value above £2 million. And in markets like London, Birmingham and Manchester and some of those other high growth cities, hitting the threshold of £2 million isn't actually as rare as you might think it would be, especially for investors who've been holding onto these properties for many years and maybe don't realize the value that they now have. There's a real chance a property bought for 1.2 million 5 or 6 years ago is now clipping up towards that threshold of being valued at that £2 million marker. If it has, you will now also be subject to this new mansion tax, and it will eat into any profitability that you have from that particular asset. And this might be something that wasn't even on your radar at all at the time when you bought the property. The really annoying thing about this one is this isn't just a one-time hit like you'd see with a stamp duty. This is something that will be paid annually and isn't cheap. It will become an ongoing cost that will erode lots of the profitability from the asset you're holding, which of course is not a great scenario. The advice that I would give to you if you're holding an asset that you think could be worth above that £2 million threshold is have that asset valued by a trusted company. Find out exactly what it's worth and whether it is going to clip into that higher bracket. Once you've done that, you can provision for the extra taxes, figure out whether it's actually worth keeping that asset versus the returns it's making you, or whether you want to get rid of that as a liability altogether and maybe restructure where your money is positioned, buy some cheaper properties, add some extra buy-to-let rental assets, something like that. Not everything in the current budget was designed to harm investors. In fact, there's actually one area where the government are offering real and genuine, fantastic incentives for any investors that are thinking smart. A lot of investors will see green property standards as something that's optional. It's nice to have if you're into sustainability, but it's not essential to their bottom line. And that can be a costly mistake. Budget 2025 has made it clear that making your properties greener isn't just about good PR anymore. It's actually becoming a financial necessity. The government is rolling out grants for EPC upgrades, and it's also offering preferential rates on more eco-friendly developments. It's also signaling that green energy standards will increasingly influence a property's value and its ability to be lent on. Properties with extremely poor EPC ratings are already a little bit harder to mortgage and a little bit harder to resell. And it's clear from the outlining of the budget 2025, the government is taking this stuff incredibly seriously, and that gap is going to widen even further. On the flip side, investors who act now can access grants to upgrade their properties. They can secure financing that little bit easier and position themselves into an area in the market where sustainability is actually becoming a premium selling point. I would always say to check the efficiency ratings on every property in your current portfolio. If you're below an energy efficiency rating of C, look into those government grant schemes and see what relief and what help you can get to bring those properties up to the standards that modern day living requires. While buy-to-let investors can take advantage of those new green incentives, there is another group of investors that are going to face an entirely different reality. Short-letting investors often would feel as though they're a completely different class and type of investor to a regular buy-to-let investor, and that they're in a completely separate category from those more traditional style landlords. They used to have more freedom to operate exactly as they see fit, but not anymore. The Budget 2025 has introduced what they're calling visitors' levies. It's a tourist tax, as you would see in many other places around the world, and it's specifically applied to short-term rental properties. This will mean that any guest that is staying in your property on a short-let basis will be subject to a nightly levy. This can translate in a number of different ways, but it could potentially reduce the profitability of your short-term let property. You could, of course, absorb those costs yourself, which will squeeze down the profitability of your investment a little bit. Or you could pass it on to the guests, which, of course, makes your property that little bit less competitive. And this is just the beginning. The government have also signaled that short-term lets and the regulations surrounding them are set still to tighten a little bit further, with potential licensing requirements and stricter planning permissions on the horizon for us all. I think it's really important after this announcement to recalculate your pricing structure and factor in that overnight visitors levy. If the numbers don't work anymore, you could consider converting that property to a traditional long-term let, or sell that property while the market is still as strong and buoyant as it is. While short-term lets are facing more restrictions, there is another rental sector that's also getting massive government backing right now. Most individual investors would assume that build-to-rent schemes are only for the institutional players and the really large-scale developers, and that these incentives just simply don't apply to them. But that's not entirely true. The Budget 2025 has announced specific new regulations specifically to encourage large-scale rental developments. The government is really pushing for more purpose-built rental accommodations, and they're backing it through some really clever tax breaks, planning incentives, and preferential financing. This is predominantly aimed at those bigger institutional investors. But here's what individual investors also do need to understand. The build-to-rent boom is coming, and when it does, it's going to change the rental landscape in a fairly interesting way. More professionally managed, purpose-built rental stock means more competition for tenants, higher standards, better amenities, and properties that are specifically designed for long-term renting. If your property portfolio consists of much older properties, maybe hovering around or below those new EPC regulations, and maybe without the latest mod cons or those extensive facility packages, you could start losing out tenants to some of these brand new buildings. I would say it's important right now to keep an eye on where those build-to-rent developments are going to be popping up. If those build-to-rent developments are near where you have a portfolio of older properties, it might be time to sell those properties on and look at something brand new. Maybe buy something off-plan where you're going to have access to all of the latest EPC, the latest mod cons, and those extensive facility packages. That means you will not struggle for tenants no matter what buildings are built around you. Whether you're investing in purpose-built, brand new off-plan developments, or whether you're buying into some of those funds for build-to-rent developments, there is one massive piece of the legislation that is going to affect every single landlord across the UK. The Renters' Rights Act is probably the biggest legislation change we've seen in property over the course of the last decade. And it's really important to make sure that you have your head around it fully and understand what it means. Whilst many investors would see it as a negative and that it's entirely designed to favour tenants at their expense, there are, of course, some new protections that have now been put in place for tenants in the UK. This isn't such a bad thing. The Renters' Rights Act has introduced sweeping changes across the board for all landlords in the UK. This includes the abolition of Section 21 non-fault eviction, rental increase limits, a new national landlords register, a new landlords ombudsman, and a ban on rental bidding wars, alongside ensuring that your homes are at decent standards level. It's also introduced a WARB's law, the end and abolition of fixed-term tenancies, 2 months' notice being required to end a tenancy, and new protections against any kind of discrimination at all. It means that landlords have more responsibility towards their tenants and gives them less flexibility in a variety of areas. You can't just evict a tenant without cause anymore. You can't aggressively hike rents, and you can't allow people to get into bidding wars to try and up what they're willing to offer you to be able to rent your apartment. And you also need to ensure that your property now meets the basic standards required to be a rental property. Much of this reform has been designed to create a more stable and predictable rental industry in the UK. It will make tenants feel much more secure. They will stay longer, which should mean lower tenancy turnover rates, fewer void periods, and a more stable rental income coming back to you. I personally don't feel like this shakeup is a bad thing. It will encourage investors to treat being a landlord as a proper business and run it that way. I would always tell everybody, register on the National Landlords Register. Make sure every single property in your portfolio is at a good enough standard to be lived in and meets those new EPC rating. Review all of the tenancy agreements that you currently have and bring them in line with those new regulations. But most importantly, make sure that you're going to understand exactly what these changes will mean for your situation. That way you can plan accordingly. Our free rental income calculator is linked below, and it will show you exactly what these new shifts will mean for your bottom line. Even with all this knowledge, there is still one critical question. How do you actually build a portfolio that will drive enough income that you can live comfortably? Because of course, understanding the policy changes is extremely important, but knowing how to structure your personal property portfolio to generate consistent income and income that's going to grow over time, that is what could actually change your life. So watch this video next, where I'm going to show you how you can retire at 55 years old with £5,000 per month using property.